Assalamu alaikum, second year commerce. Today we are going to start chapter number 9, that is Negotiable Instrument 1. When we start this chapter, in your book there is a definition of word credit. Then we will look what is a credit instrument, what are the characteristics of these instruments, and what are the kinds of credit instruments. And the first credit instrument, that is a check, is discussed in this chapter. We will look into this first credit instrument, check, in detail. We will discuss about the definition of check. We will discuss parties and elements of a check, characteristics and advantages, kinds of check. Then we will compare the different kinds of check. We will do the comparison. We will discuss the reasons why the checks are dishonored. What is the meaning of dishonoring of a check? We will see what we meant by this endorsement of a check, and we will see how to cross the check. So the first credit instrument, that is a check, credit instrument 1. Before starting the instrument, which is a check, we need to know why we are saying these are credit instruments. So now look, what is the credit? The ability of a customer to obtain goods or services before the payment, based on the trust that the payment will be made in future. Simply, in the simple word, we mean credit means the loan. We give someone a money or a service or good. Over here we are talking about good. The ability of a customer to obtain goods before the payment, like you have not paid for the good, you have not paid for the service, but you already availed the service, you already taken the good. And why customer has taken the good or service? Because it is a trust that payment will be made in future. Nowadays, credit plays an important role in the economic development of the country because the business is impossible without credit. Now, when we take a credit, it means we are not paying the money, which minimizes the need of money. We are taking the credit now, we will give the money in future, so we don't need money now, we don't need money today. That is why the word credit we are using. We are taking the good, we are availing the service, but we are not making the payment. It is surety, it is the trust that the payment will be made. Now moving on the chapter, derivation of the word credit. The word credit has been derived from the Latin word credo. Credo means I trust, I believe. It implies confidence or trust in an individual's solvency. So the word credit, we trust on the customer, we trust on the other person. That is why we give him or her a credit. According to Professor D.J. Lockett, this is written in your book, when a person obtains loan on security of his property and takes responsibility, okay, and the person is taking a responsibility, I will make you a payment in future, it is called credit. Now the thing is that what we mean by credit instruments, why check is a credit instrument, why we are saying check is a credit instrument. Now instrument in a banking, in the whole bank, usually the word instrument, piano comes in our mind, guitar, drums, we think these things are instruments, but in a bank, instrument is a paper. What is in a bank? What is instrument? In a bank, instrument is a paper. It is a piece. It is a piece of paper. Now we are saying instrument is a piece of paper in a bank, and we are saying that this is the paper which is not actual money, but serve as money and perform all its function. What does it mean? It means this is the paper. Credit instrument is a paper. It is not money, but it has all the powers of money. Remember, you have studied the functions of money in the grade 9. It preserves the value, it transfers the value, it is the medium of exchange. Similarly, all the things we studied for money is all are applicable implement for credit instruments. So in a bank, instruments are the piece of paper and they have all the powers which money has. Again, I am repeating my words. It is not a money, but it is a substitute of money. It holds all the powers that money has. These instruments are called credit instruments. Credit instruments are the media by which credit is created. Now, why we are using the credit word with these instruments? In the whole business world, nobody uses the money. They use these credit instruments. Now, look at the whiteboard. We are saying one side I'm writing the money, and on other side I'm writing the credit instrument. That credit instrument is not money, but it has all the powers of money. It has credit instrument has all the powers of money. It performs all those functions which money can. Again, keep in your mind, this is not a money. When you go to a shop, you give money and you buy good. We can give the credit instrument and we can buy the good. These credit instruments are used in the business world. No one uses the money, the physical money, they all use credit instrument. They use credit instruments to make the payments and to receive the payments. It is not money, but it has all the powers of money. It has all the functions of money. Now the thing is arises why we are putting the word credit over here, credit instrument versus money. Now what is the difference? All business world is using the credit instrument. When we go to cold store, when we go to any retail shop, we give money. But in the business world, when we give the payment to trader, to buyer. Now look, the first instrument we discuss is the check in this book. That check is a credit instrument. When we give check to anyone, like this is one person and this is another person. Now this person has to make the payment, like let's say 20 BD payment using check. He gives check to this person. So now tell me when this 20 BD is going to realize. And now look over here, when we give money, like this person wants to give money 20 BD. When this person is give 20 BD over here, 20 BD from his pocket comes to the pocket of the second person. In this example, the transaction realized on the spot. It means the transaction is going to realize on the same time. Similarly, this person has given the check to another person. What do you think? Over here, transaction has realized or not? Your answer will be no. Transaction is not going to realize on the spot. Why? Because this person still not received the money, which is a physical money. He just received the check, which is a credit instrument. So now this person will take this check to his bank. He will deposit the check of 20 BD into his bank. Bank will send this check to a clearing house. Then from the clearing house, the amount will come to his bank account. Maybe after 1 day, this transaction is going to realize after 1 day, or maybe 2 days, 3 days. After 3 days, 2 days, he is getting the 20 BD in his account, and then the transaction realizes. That is why we are using the word credit with these all instruments. Because when we pay someone with the help of credit instrument, it means the transaction never realize on the spot. This is the seller and this is the buyer. So seller will get the payment not on the spot, after next day, maybe after 2 days. Between these 2 days, this will be a creditor and this will be a debtor, because still the payment is not realized in this transaction. What does it mean? When we give someone a credit instrument, payment realizes next day or maybe after 2 days. So in this time of span, the seller is the creditor and buyer is the debtor. That is why we use the word credit with these all instruments. When the transaction is international transaction, payment realizes after 15 days, maybe 7 days. So there is no debtor and creditor relationship when you give money to anyone for the payment. For example, you went to a cold store, you bought a Pepsi, you give up money. So this is the end of the transaction on the spot. Come to the business world. When we make the payment with the help of credit instrument, we give a credit instrument, there is no end of transaction. Transaction will end when the payment will realize into the seller's account. So now coming back to the slide, credit instruments are the media by which credit is created. So when we are making the payment using credit instrument, so it means credit will create it automatically, because the payment will never realize on the spot. Payment will realize in future. In a credit transaction, the receiver of credit promises to pay cash at some future date. The promise to pay or the evidence of indebtedness given by the debtor to the creditor is called is the credit instrument. For example, what this point is written, if I have given you a credit instrument, if I have given you a credit instrument, it means you have the evidence now. You have the evidence that I am in indebtedness. I have to pay you. I have given you a credit instrument. You are the seller. I am the buyer, and I am in indebtedness of you because I have given you a credit instrument. So it is a proof, it is a promise, it is a proof, it is the evidence of indebtedness that given by the debtor to the creditor. So seller is the creditor and buyer is the debtor. So when buyer will give the credit instrument to a creditor, it is the proof that buyer has to make the payment. Okay. So this is the credit instruments. Now see over here. Promissory note is a credit instrument. This is a check. Check is a credit instrument. And bill of exchange. Bill of exchange is a credit instrument. Bank draft is a credit instrument. Again, I'm repeating, these all are not money, but they have all the powers, all the functions of money. We promise someone, one person is promising another person that I will make you a payment. Over here, when we give check, it means we want to pay this amount to the person to whom we have given the check. So the transaction is going to realize in future date. Again, a bill of exchange, always written by exporter to on importer. So it is a demand of a payment from the seller that give me my payment. Again, in future, the payment is going to be made. Similarly, the bank draft, these both are the bank draft. When we make a bank draft from the bank, so payment never realizes on the spot. Payment is going to realize in future date. Letter of credit, LC. Again, it is a credit instrument. Okay, now in the next, we are going to end over here. Inshallah, in the next class, we are going to study the feature and credit of credit instruments. That credit instruments are always in writing. They must be unconditional. They are the substitute of money. Without credit instrument, foreign trade is not possible. It is a proof of debt, reduces the risk of loss, because when we use money, money can be theft, money can be lost. But credit instrument, when we use credit instruments in the business world, it reduces the risk. It saves the time and labor, because when we give someone a money, other person needs to count the money. Note could be a fake. A person needs to check each note. There are many chances of fraud. Maybe the currency is not original one, it is a fake currency. So it saves time and labor both, for if we use a credit instrument and if we are not using the money, and it facilitates trade. Inshallah, in the next class we are going to study all the characteristics in detail.